Hello and welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500, and today is Centene Corporation, ticker CNC. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. Now, first up, this company has a $49 billion market cap, a $55 billion enterprise value. You see about $6 billion in leverage there, which should increase the return on equity higher than the return on invested capital. They're operating in the healthcare provider and services industry. A little bit more description, they're a multinational healthcare enterprise. Provide services to underinsured and uninsured individuals in the United States. Has a managed care segment. Uses government subsidized, like Medicaid. Let's see what else this has. Also has specialty services segment. They provide pharmacy benefit management services. So pharmacy benefit management services and providing government subsidized programs to underinsured, uninsured individuals. So that's the business model. Now, what's interesting here is the beta of 0.52 is quite low for an S&P 500 company. Of course, a beta of 1 would mean that the volatility is in line with the rest of the S&P 500, but at 0.52, it's very, very low. It means it's a less volatile company in terms of its price, but it usually correlates to less volatile in terms of its business. Now let's see if that holds true. Now, what can we glean from return on invested capital? Now, the first thing is I love looking at these charts because it really tells you a lot of information in a glance. First thing we can see is that they have only 1 year of losses in the last 20 years. That's actually a really good sign of a high quality business. You ideally would have 20 straight years of profits, but having only 1 year of loss is not that bad. 19 or 20 years of profits out of a 20-year period is my threshold for a high-quality company, and so it's meeting that part of the threshold. Now, we do see 2012 that they almost lost money, and so there is something going on here. But one thing that I'm curious about is because of the nature of these drops is that's not normal. This isn't like there's a lot of cycles going on. It's not like there's a steady drop there that drops down. I'm wondering if there's some one-time items that's causing those losses, and it's not necessarily actual losses in the business from operating results, but it's a non-operating result. That would be a curious thing that I have a question about. And it seems quite possible that that could be true. Now, the second thing that you instantly see here is that these results are getting worse over time. You start at 30% return on invested capital in 2002. You end at 2% in 2021. So these are just consistently getting worse. And it's like year to year, every year gets worse. If we skip from 2010, you got 13, 12, 9, 9, 9. 2012, you got on a 0. But then again, if you look at 2014, you're at 11.9%, 11.7%, 8, 7, 6, 5, 5, 2 or 3 basically. So you have basically a decade of deteriorating return on invested capital, and that's not what you like to see, because if you extrapolate that out in the future, it would just keep getting worse. I mean, how much lower do you go from 3%? So they're reinvesting at very poor rates of return here. And so I don't like seeing that as a business. If I'm going to hold it for the next 10 years, that's actually quite a negative outlook. So I'm not liking what I see here from return on invested capital. Now, if we go to 10-year median returns, especially when you take into account that this is deteriorating, these 10-year median returns are simply too low. I want return on invested capital to be above 10%. It was in the previous decade, but the last decade it's gotten worse. And return on equity, I want to be above 15%. Those two numbers are important because I like to have a 10% rate of return on my investments, and I'm unlikely to get that as with these low numbers. In addition, you have an extremely high PE ratio of 33. This is well overvalued based upon what we're seeing here. You're paying an extremely high price for relatively poor returns on invested capital. And the only reason you can justify that is because you have extremely high rates of growth. So your revenue is growing at 37%. But the reason your return on invested capital is getting worse is because you're growing your assets at 43%. So you're growing your assets 6% per year faster than revenue. So all of that is leading to free cash flow and earnings per share growing substantially slower than your revenue. In addition, without even looking at the next, the income statement and balance sheet, we can clearly see that they're probably diluting and raising debt in order to do this, because the only way that you're able to grow your assets so fast without having adequate returns on equity is that you're either issuing new equity or you're using equity and debt in order to fund your growth, because you can't fund it if the asset growth is higher than your return on equity. It just doesn't work. You're getting a 3% return on your assets and you're growing 43%. Where does the other 40% come from? It comes from debt and more equity. So that's a very bad sign for investors. You look like you're incredibly overvalued, and it's not like this number is just out of place. I mean, your peak earnings here is $3.14 in 2019, and yet you're still trading at 25 plus that number. So it's not like this number is just like abnormally low. 2021 wasn't an abnormally low number. It was 30% lower than this, but that would simply still leave you with a PE in the 24 range. So you're still looking at an incredibly high overvalued company. So high overvalued, deteriorating financials, it's looking bad here. This is not something that's super interesting, but you look at the revenue growth in it and it's kind of crazy. I mean, you've gone from $8 billion per year in revenue to $125 billion in a decade. I mean, if you repeated that over the next decade, you'd have over $1 trillion a year in revenue, which means most likely you're not going to repeat that over the next decade because your returns are simply not going to be that high. You're not going to be able to sustain that revenue growth in the future. But if you are, maybe that's interesting. If you're enjoying this video so far, please hit the like button down there and also hit that subscribe button. By subscribing to the channel, you can work with me as I work through every company in the S&P 500, and we will continue on to the income statement now. So the income statement. One thing you see here is gross profit profitable every single year, operating profit every single year for 10 years. That's a really good sign. This net income was barely positive. Now, you don't have a big non-operating income loss here, so that's okay. I was concerned that maybe that was an impact here on what that 2012 number, if you remember, I was trying to understand what's going on in 2012, but it doesn't appear that you had a giant non-operating expense or something that would distort it. Now, look at what happened here. This is exactly what I predicted. You've gone from 206 million shares outstanding to 583 million shares outstanding. So the only way you've been able to grow so fast is you have more than doubled your shares outstanding. This right here, more than anything else, is showing that this company is not being managed in the interest of shareholders. It's being managed in the interest of either management or employees or other stakeholders or something, because shareholders have gotten fleeced in the ability for them not to benefit from the growth in their business. They've gone from, let's ignore this 1 cent, 74 cents in earnings to 228 cents in earnings. They've tripled their earnings per share, and yet net income is up 8 times. So you're 3 times higher in EPS, but your net income's up 8 times. The only reason that works is because you've more than doubled the shares outstanding, and so other people own those shares. You're not getting that benefit. It's a big detriment for shareholders when they continuously dilute like this. Now, balance sheet. What can we see here? So it's hard to tell what this investments line number is. That's going to distort my thinking here. So I'm not going to spend too much time on the balance sheet. Your PP&E is pretty low at $2.7 billion, especially when you think about a company that's bringing in revenue, in that $125 billion range. You have a lot of goodwill and intangibles. So there's clearly big acquisitions taking place. And again, that distorts some of the numbers you're going to see. But you do see this, long-term debt has gone up significantly. You basically had $300 million in long-term debt. Now you have $18 billion in long-term debt, which is significant because it's substantially higher than your retained earnings. And you see this growth in paid-in capital. So, all this is coming into play from these acquisitions, these growth in these assets. And that's destroying those returns on assets. Because of these big acquisitions, because you're issuing those shares, because you're issuing those debt, you're getting worse and worse returns on the asset base that you have. Now, some would say, okay, well, it's an intangible asset base. And that's true, but it matters for investors if you're going to continue to make acquisitions, if you're going to continue to do this. Those acquisitions do matter for the returns on your portfolio. So PP&E, you can see relatively low investment in PP&E, but you have these big acquisitions taking place on a relatively frequent basis. These investments are interesting because I don't really know what those are. So it's hard to assess there, but you can see a pretty constant issuance of debt every single year. Relatively low stock buybacks, a lot of stock issuance. You're actually issuing a very high amount of stock-based compensation, $200 million in stock-based compensation, and that's exceeding basically the amount of stock being bought back, which is why you're diluting to a massive degree over time, including big issuances at times for some of these acquisitions. And that's, what's destroying those returns for shareholders. So for me, I would avoid Centene Corporation. I don't like what I see here. I don't like that this is getting worse and worse over time. Basically, the company is intending to grow as fast as possible, whether they have the profitability to support that growth or not. So the growth at all costs is the mindset as that I discuss here. You're paying a very high PE ratio. The only reason this PE ratio probably exists is because you have high growth, but the growth is being paid for by dilution and debt. So it's basically a house of cards waiting to collapse if I had to assess it. So I would avoid Centene Corporation. It's not something that will go on my watch list because it's both overvalued and appears to be a low quality company. Thank you for listening, and don't forget to subscribe. Please hit that subscribe button and like this video if you enjoyed it, and stay tuned for the whole S&P 500 series that I have in the playlist available for you to click now. Thank you for listening, and until next time, stop paying fees, start building wealth.